In this video, we're going to be analyzing Starbucks stock. It's one of the most popular dividend stocks talked about here on YouTube, but we're actually going to be analyzing them from a pure financial point of view. So we're going to be leaving out things like the unions and the kind of egotistical CEO that we just had on the interview. And they kind of have some protests going on, but I know some people that work at Starbucks and they've said over the past couple weeks, traffic has really started picking up again. But anyway, hope you guys will join me today as we analyze financially Starbucks stock because the earnings, if I'm being honest, really weren't that bad, especially if you analyze the numbers. Like right now, their 3% dividend is only at a payout ratio of 62%. That's for the trailing 12 months of earnings, but they're still leaving for themselves 38% of every dollar that they make for themselves to do whatever they want with. And they also have a free cash flow yield of almost 5%. It's 4.7%, but it's one of my favorite metrics I like to look at, especially when it's well above the dividend yield. We want the free cash flow yield to be above the dividend yield because that means they have room to raise the dividend. But they're also trading at a forward PE ratio of 16.73. Like that is dirt cheap, and a PEG ratio, so price to earnings growth, of 1.18. Anything below 1.5 is considered super undervalued. And here are their super impressive margins: gross margins of 68%, free cash flow margin of 10%, but most importantly, an ROIC of 25%. That is super impressive. And I'm hearing people say right now, yo, don't catch a falling knife, wait for the stock to bottom and then buy it. But honestly, I think right now is a really good time to slowly start dollar cost averaging into Starbucks. This is still a huge company, $83 billion in market cap. And that market cap is cheap if you annualize their net income, or let's actually go look at their net income right now. So in the most recent quarter, in that red number, it's down 14.95% year over year, but look at the quarters before this. Look at the year over year growth rates they were growing before this. 19% the quarter before. Like, these are crazy growth rates for a restaurant stock. And so when they're down 14% like this, I'm not actually too terribly concerned because they just grew like crazy over the past year. They're basically where they were at 1 year ago. But either way, let's look at the most recent quarter of $772 million in net income. This is why there's still good news. That still easily covers the dividend. The net income was well above the $645 million of the dividend cost, so they still can't afford the dividend, which is really good. And if we go to their diluted weighted average shares, they didn't dilute you in the most recent quarter either. You actually own 1.5% more of the company, so you get a 3% dividend yield. And if they continue to buy back stock, which I really think they will, especially at this discounted price, that could be really good for the long term as a shareholder if they buy back stock at this discounted price, because the company has a huge history of buying back their own stock. Actually, the quarter before this, they bought back $1.23 billion of stock, and if you remember, the market cap is $83 billion or something like that. So that's well over 1% of the entire company. And Starbucks actually has $15.59 billion of debt, which is extremely manageable. Like, it's flat over the past year. It's the same as 1 year ago. And they also have cash right now of $2.76 billion. So they're actually chilling on quite a bit of cash. And the rest of the debt they can easily pay off with their net income, almost $1 billion of net income a quarter. But if we go to their free cash flow, like last quarter, they made $2.38 billion of free cash flow, which could knock out a huge chunk of their debt if they wanted to. All right, so here we are on the Moomoo app. We're going to be seeing what people smarter than me are saying about Starbucks stock. Like, we're going to be looking at the analyst, which has an average price target of $89, 21% higher than right now. And we're also going to be looking at the Morningstar research. They have a fair value of $105, 42% higher than here right now. So we're going to be seeing their opinion on why they think that. But we also get a look at some other cool stats, like the total number of stores. In 2022, it was 35.7. Now it's almost 39,000, 38.95. We can also see the revenue breakdown, which China only makes up 8.57% of their entire revenue, so I don't think it's too crazy of a big deal. And we can see what they're selling in. Oh, and if you're curious, here are the EPS estimates from S&P Global. They're pretty cool. If you're wondering what this app is, it's called Moomoo. They have so many cool different features. If you want to help me out, support the channel, I'll leave an affiliate link in the description. But let's see what the bulls say, or this is the Morningstar research. So let's see. This was updated very recently after the drop. So let's see what the bulls say. And let's see what the bears say, because it's always good to know what the bear argument is. So I was reading all the bearish arguments, and of course pause and read it for yourself, but it doesn't really look like that big of a deal. It's talking about China and the commodity of coffee beans, which is talking about a shrinking Arabic growing regions could drive higher coffee prices, but that's a commodity. You don't really think about that. So I'm not really seeing any real bearish argument news here. And I'm not going to read the bull case either, but feel free to pause and read it. We're going to be looking at some of the more other important things that they're talking about. So now I want to read this together with you guys. This is talking about their financial health, and it says they have few hard assets, which is true. That's why most people get turned off by this when you actually shouldn't. It's because Starbucks leases. Anyway, let's actually keep reading this. So they believe that operating income based metrics are more appropriate to look at to see if to check their liquidity. So they have a debt to adjusted EBITDA at 3.4 times in 2023, and they expect to trend lower over the next 5 years to 2.0. And they don't expect any liquidity concerns because of how much they're making. Our model anticipating a robust EBITDA to net interest coverage of 17 times for the full year of 2024. And they have Starbucks has a strong free cash flow conversion, averaging from 9% of sales through 2028, offers a lot of flexibility for them to invest in new things like technological improvements, new restaurants, and menu innovations. And here are their actual expenditures that they estimate. We expect them to prioritize capital expenditures estimated at $16.3 billion, and dividends $13.5 billion, and share repurchases of $18.4 billion, and maintaining a target of 50% dividend payout ratio. If you remember right now, they're at a 64% dividend payout ratio, so they're expected to grow their earnings. So now we're going to be looking at the analyst forecast, seeing what they're saying. Their very low bottom price target is $75. So let's actually see what the popular analysts or institutions are saying. So they leave a hold at 85, but if we scroll down, we got like Wells Fargo, they have a buy rating, and you can see right under the rating when these were updated, all on May 1st, you can see the dot on there, so you can see when they actually left the rating. But as we can see, no one really has a crazy bearish price target. I'm not seeing any. But thank you guys so much for watching. I actually just made a video called 5 dividend stocks you should never sell that I've super carefully selected. So if you want to help me out and check out that video on the end screen, I really appreciate it. But I hope you guys have a great rest of your day. And if you leave a comment in the comments saying, hey, I bought Starbucks or something, I'll respond to it.